Man, I'm not even gonna lie. Today's video is a classic. This one's a good one, okay? So much to go over in this video here today. So many things to show you guys that I haven't talked about on the channel in quite some time. Some very important information I have to give to you. A big tech company is about to do a major layoff. I want to talk about that. That's a stock I'm sure a lot of people have been buying recently that just seems to hit new 52-week low after new 52-week low. So many perspectives I want to share about kind of the state of the stock market right now. Obviously with, the Fed decision here today, kind of what that means. I was buying some stocks right before the market closed here today. I want to share with you kind of what I was out there buying, which I bought a lot of different stocks, and I'll kind of show you guys that. But yeah, anyways, this is just a good video. Hope you guys enjoyed as always, and I appreciate everybody joining me as always and being subscribed to the channel, okay? First thing, I haven't talked about this in a long time, but if you want to find the biggest crash, go ahead and look at margin debt. Margin debt has been crashing. Now, this is extremely healthy for the stock market. We got definitely pushed up to levels in terms of kind of what we are reaching as far as people taking out margin debt. Yeah, we got to some pretty scary levels. I mean, we were approaching $1 trillion in margin debt outstanding from the retail side back in October, November time. We got to some very unhealthy levels. Now, this is always a kind of, it's a dated numbers as far as what they show us. If I was to guess where we are at today, there's probably about $575 billion to maybe like $625 billion of margin debt outstanding as of right now, somewhere around there, which if we look, that's around where we roughly were prior to Rona. I think we're starting to get to very healthy levels here. If we go back to 2019, we were consistently in the 500 to 600 range. If we go back to 2018, consistently in the 500 to 600 range. And I think that's exactly where we are at as of today, as of, I don't know what's today, September 21st or 22nd or whatever this is, of 2022. I'd almost guarantee you we're somewhere in here roughly, which has gotten us to much more healthy levels. Because when you start seeing margin debt going, let's just call it crazy, it's not healthy. It's not healthy for the market. It means people are obviously ultra bullish, and you need to see those numbers come down to more realistic ranges. Now, as the stock market becomes more valuable over time, it's natural that the amount of margin debt outstanding will increase over time. But, when you start talking about you were at 500, 600, and then you start approaching $1 trillion in margin debt, you're usually in, let's just call it a FOMO time period, which obviously we are in during that whole situation. We have never, ever in history of the stock market seen a drop this dramatic in margin debt ever, okay? And the reason this is, even in the great financial crisis, it wasn't to this scale or even close to this scale, to be quite frank. The reason margin debt has collapsed as dramatically as it has, okay, it's two factors. One is the part I have up here, and the second factor is also very important, okay? The stock market went from ultra bullish in 2021 to ultra bearish in 2022. That rarely ever happens, where you get that FOMO period of just everybody's so bullish, right? To then within less than a year, no one wants to own stocks. Everybody's so pessimistic. Everybody's so bearish on the market, right? It almost never happens where it happens within a 12-month span, ultra bullish to ultra bearish. Even in 07, through the 09 crash, we didn't have that level of ultra bullishness into ultra bearishness, right? We got the ultra bearishness, but it wasn't like in 07 there was ultra bullishness in the stock market at that time. Maybe in the real estate market you could have said something like that, but not in the stock market. It was kind of like, I'd call it overall bullish, but not ultra bullish, okay? Now, the second factor on why margin debt has collapsed so much, and I think this is very important for everybody to understand, you see how the Fed keeps raising rates? Well, when the Fed keeps raising rates, if you have margin debt or you're thinking about taking out margin debt, you're going to have to pay a lot more to your brokerage, which makes it very unrealistic to take out margin debt, right? Which means people sell off their margin because they're like, oh my gosh, I have to pay now. Some people are probably paying 8, 9, 10%, if not over 10%, if they're taking out margin now at this point in time, right? Even if you have negotiated custom rates, which I do, which, I try to stay away from margin, but I, negotiate it because it's just fun to, have the money there and look at it and be like, oh man, I was looking at the public account today, I got $1.5 million of margin. I could do if I wanted to do, but I'm not going to do because way too scary as far as that whole game goes, right? But even if you have a negotiated rate, let's say like me, like at 1.9%, right? Well, as the Fed keeps raising rates, the prime rate keeps going up. You have to pay on top of that. So, even somebody like myself might have to pay 5% realistically if I wanted to take out margin right now, right? Now you're talking about big numbers, right? Which, when you have no clue where the bottom is going to be for the market, very, very scary because you can get into margin calls. So this is bad news for the stock market, right? In the short term, great news for the stock market over the long term, because this is we needed to get back to realistic ranges in regards to margin. Okay, now in regards to today, obviously market sold off heavy at the end of the trading day. I mean, really heavy. Out of nowhere, the Dow dropped 500 plus points. NASDAQ dropped almost 1.8%, over 200 points in the NASDAQ, and that came fast, man. I mean, it was like within the last 30 minutes of the trading day were just brutal. I mean, just brutal down. It was sell everything in sight. It didn't matter what stock it was. It got sold off massively. It did not matter, okay? And it was crazy because, this is like a picture I took, when Powell was speaking. And at first things were really red. Next thing you know, I opened my computer and it was like, holy smokes, man, everything had gone green. And next thing you know, by the end of the day, it was Red Dead Redemption out there, which goes to just kind of show you there was really nothing in that press conference or the release that, was that game shaking, because if there was, it would have been a clear move either down or up right away. And it wasn't. It was like down, it was up, it was down, it was up, and then it was down, okay? And so that was just kind of interesting to kind of see how that plays out. It was pure speculation moves. And today was a day where patience really paid well, okay? Because if you were patient throughout the trading day and you waited to kind of the end there, obviously you got stocks at literally the cheapest price of the day as long as you were buying in those last 5-10 minutes of the trading day, which is something I did complete out there. What was I buying here today? Well, I was buying. Take just a moment to show you Tendies, which is today's video sponsor. Some of the coolest stuff I've seen out there. I'm checking Tendies on almost a daily basis now at this point because this is pretty epic to see. And everything I'm going to show you here, you can get access to this for free if you use the pinned comment down there, okay? So what I sorted here is the biggest premium that went through on the options market today, okay? Now check this out. This one caught my attention. USO, somebody's betting heavy that oil is going to go down. They bought $60 puts. USO right now is trading at about $70 roughly, okay? This is expiring December 16, 2022. $3 million move. Ooh, somebody's pretty confident oil is going to go down. Now, this is shocking. Look at this, okay? I typed in Apple. So the biggest move here today was somebody loaded up on $70 put options on Apple. That's way out of the money. That's insane, okay? That they think the Apple stock's going down to $70 or below by basically June 16th of 2023. Tendies has options flow, ticker details, a curated investment feed tailored to the stocks in your portfolio, in rooms where you can talk with other users about any publicly listed stock. Obviously, I love Tendies personally for the filtered options flow. Other competitors in this industry are charging between $40 and $350 a month for the same type of data that Tendies is giving away for free. Once you connect your brokerage due diligence, it's all in one place. So filter out the noise and use Tendies. I love it. Make sure that you click the link that is in the description. It will also be the pinned comment down there as well, just for easier access. Take advantage of this market chaos. Once again, that will be pinned comment. These stocks here, okay? I bought 23 shares of Meta at $142. I bought 222 shares of Corsair at $12.77. I bought 10 shares of McDougal, at right about $100. I believe it hit the 99 range before the end of the trading day or somewhere around there. I bought 111 shares of the Chef at $548. I bought 200 shares of Palantir at $769. I bought 7 shares of Amazon at $118 there. So obviously I get the e-commerce big beast along with cloud. I get Palantir, which is data and artificial intelligence to help companies make better decisions, and governments as well. I obviously got food company there. I got McDougal, which is just an overall beast of search and video. I got Corsair, which is a stock that's been absolutely obliterated. Gaming hardware, obviously, and streaming hardware. And then I got Meta, which is just a stock that can't get out of its own way right now, okay? Now, I reacted to a video last night on my new channel, Jeremy Lefebvre Makes Money, which thank you for everybody that's subscribed over there. We're approaching 13,000 subscribers now. Holy smokers, okay? And it was one in which Josh Brown was talking about, we're going to have a face ripper rally, okay? And I was interested to wait to see what he had to say, when he got on CNBC today, because, yeah, if anything, we didn't. And Josh Brown did say that, if anything, he got his face ripped off today. And this is why, it's cool to make those sorts of short-term predictions about, oh, I think the stock market is going to go up a ton or down a ton, tomorrow or next week or things like that. But it's such a tough game to play because, the setup definitely could have said, maybe we have one of those face ripper rallies. But at the end of the day, you make that prediction out there, and then he doubled down on it yesterday. He made the prediction 2 days ago, doubled down on it yesterday on CNBC, right? Everybody gets to see this. And, yeah, well, obviously we didn't get the face ripper rally. We got our faces ripped off. If anything, it was nasty, okay? Absolutely nasty. And so, that is kind of what it is. But the worst thing for Josh Brown is he lives in New York City, and somebody posted this inside the private stock group's Discord chat today. Oh my gosh, look at the prices for Chipotle in NYC. You gotta be flipping my flapjacks. What? That's a holy smoke. This ain't no joke. It's almost $17 for a steak burrito. Oh my gosh, okay? Buy some chef and heat it up in the microwave, okay? Jeffrey Gundlach went on CNBC today, and basically what he said is he said that the Fed needs to stop raising so aggressively. They're going to push the economy into recession. And, at the end of the day, the Fed's willing to take that risk, and they've been very clear about they're willing to take that risk. Why are they willing to take that risk? Well, because they see inflation at 8% plus, right? They need to get that down by any means necessary, essentially, right? And then they can worry about everything else. But the longer you kind of let inflation be out there, the more problems it's going to cause, not just in the short term, but causes down the long run as well, right? Because it hurts people in the short term because, if you make $50,000 a year, $60,000 a year, right? And your grocery bill just is going up massively, and all your needs-based things have gone up massively. That creates a big financial problem for you, not in the short term, right? But imagine that carries on year after year after year. It's one thing if this is just a 1 year kind of freak event, and then we get inflation calmed down majorly in 2023 and down to, let's say, the 2 to 4% range, right? That's one thing. But if we keep having inflation at 7, 8, 9% like we've been, and you have that for several years, you're talking about big problems in the economy, and the probabilities of an extremely severe recession go up immensely, right? So it's like, do you want to take some short-term pain for long-term gain, or do you want to kind of not have the short-term pain, but then have potentially massively more long-term pain there, right? And so, yeah, that's just something to kind of take into account. So I'm very understanding of this whole situation. Obviously, if we could go back in time, the Fed wouldn't have pumped as much money. The government and states wouldn't have pumped as much money out there. But you can't go back in time. We have what we have to deal with, and it is what it is. And the Fed's they're obviously just full go on trying to get inflation down. That is their full focus, as it should be right now. Unemployment's incredibly low right now. There's still plenty of job openings out there. So as of right now, you don't have to worry about, I don't want to say you don't have to worry about recession, but you don't have to worry about massive job losses. The Fed has two jobs and two jobs only. One is price stability, and the other is keeping unemployment as low as possible. That's their two main jobs. And so if unemployment's incredibly low, historically ridiculously low right now, right? Well, they have all the room in the world to raise rates as of right now, right? And if they're willing to risk a recession because they've seen inflation at 8, 9%. And remember, those are numbers that a lot of people feel like are, way off. A lot of people feel like the real inflation rate is something like 15 to 20%. Keep that in mind for a moment, right? So if you're the Fed, what do you have to do? You got to do everything in your power to fix the main problem you have. The main problem you have right now is not employment. The main problem you have right now is price stability, okay? So that's just kind of something to kind of factor in there, all right? Now, the NASDAQ's had an incredibly dramatic fall over the past month and a week, roughly, right? This is since August 15th. The NASDAQ is down 14.5% in such a short amount of time. That is, if we go back and we looked at history, the amount of years where the NASDAQ went down more than 14% is very few and far between. Never mind in a 1 month and 1 week span, 14.5%, that's ridiculous. But it goes to show you how pessimistic and bearish, obviously, Wall Street is at this given moment, that they want no part of stocks right now. They're just like, I'm selling, everything. Imagine for a moment, if Apple had been keeping up with the market, the NASDAQ would be down 15, 16, 17% right now. Apple's actually tried to hold the whole show on its back. It's tried its best. But yeah, if it if Apple had been doing bad like many of these other stocks, gosh, we'd be talking about NASDAQ down 17, 18% just in the past 1 month and 1 week. Crazy, right? Meta stock can't get out of its own way. It hits new 52-week low after new 52-week low after new 52-week low. It's not just that it's at 52-week lows. It's at multi-year lows when it comes to Meta. This stock, this stock is lower than it was 5 years ago. It's incredible kind of what's happened to the share price of Meta, and just continues to get devastated. And, obviously countless stocks have gotten devastated, but just it's extraordinary to see this level of this stock just continue to get obliterated, to be quite frank. Okay. Now Meta's looking to cut costs by 10% or more over the next few months, and some of that could obviously include job reductions. And my opinion on this is, I think Meta way overhired. I'll be quite frank. I think they are way overhired. I think their growth rates have slowed down substantially. And I think what they're dealing with is what a lot of big tech is dealing with right now, where these companies way overhired. And here's the thing: when your growth rates are extraordinary, right, and you're growing revenues 20, 30%, you don't really notice the dead weight that's in your company, because you're in such growth mode and everything's going so well and you're reaching record profits, record revenues, everything's going great. Your stock price is being rewarded, right? Like at that moment, you don't even pay attention to the dead weight that's in your company. But believe me, you're going to hire a lot of dead weight in that company over time. And you're going to also have added a bunch of probably costs of business outside of just employment that is weighing on your profits, but you don't notice it when times are great. But as soon as the tide rolls out, right? As soon as your stock price starts to fall, as soon as your revenues aren't quite going up the way they used to go up, as soon as your net income starts being hit, and you start getting the pressure from your big shareholders, your investors, right? And your board of directors, next thing you know, you start looking around, you're like, look at all these dead weight employees that aren't holding their end of the bargain up, right? You start looking at the cost of business and you're like, what the heck, we're paying $50 million for this, and we're paying $10 million over here, and we're spending $100 million in advertising over here on this thing, and are we even getting a positive ROI? You start looking at your business with, let's just call it like a needle in a haystack situation, and you're looking for every little detail here, and what's the problem? I'm going to find everything here, okay? And that's what happens in one of these kind of down cycles. No, what emerges from that is a very healthy organization, but obviously it causes short-term pain there, right? So what I think is going on, what is going on with Meta is going on with across big tech right now. Every single big tech company has been talking about this over the past few months and will continue to for the rest of this year. And for these big tech companies, they don't get many times when they can cut dead weight. And when they can, look at the expenses of their business model. This is one of the rare times they actually have that opportunity because of all the weakness in the financial markets, all the scare about recession, slow growth rates, slow economy, or slowing economy, we should say, right? This is one of their rare moments they get, that if Meta cuts a bunch of employees or cuts a bunch of costs, and Google does, and Apple does, and Tesla does, and Amazon does, right? Microsoft, all these big dogs. This is one of the rare moments that they can do that, and no one will second guess them, right? If they do this in a good time, when their revenues are skyrocketing, then people look at it and like, oh, something wrong with them? Why are they cutting all these costs? Why are they cutting all these employees? Right now, everybody's very understanding of what's going on, okay? So yeah, when times are great, dead weight's allowed. Not right now, okay? Now, everybody's looking at what's going on in the financial markets, and they're thinking this is such a bad thing, right? It's very doomsday and all these things. And I have to ask you, is this really bad, what's going on? Margin debt is crashing right now. Is that a bad thing or a good thing? Is that a healthy thing for the financial markets over time, or is that a not healthy thing? I think that's pretty darn healthy, okay? All stocks in the stock market right now, pretty much every single stock in the stock market right now, is either undervalued or fairly valued. Is that a healthy thing for the market or unhealthy? I think that's very, very healthy. The fact that almost every single stock I could possibly look at in the market is either fairly valued or undervalued, it's good. It's very good, okay? Companies are actually caring about profits again, versus before it was all about the revenue and what's the growth rate they're going to have. And investors, obviously, and the only reason companies care about this, by the way, is because investors now care about this. Investors have sold off everything that doesn't make money massively, right? And they sold off every company that even, like a Meta that's focusing on revenue growth and big growth opportunities, right? So now all of a sudden these companies have to start caring about net income again. gross profit again. Well, is that a healthy thing or an unhealthy thing? I think it's a very healthy thing for these companies and for the financial markets that we actually care about this again, okay? Investors are thinking about their risk and how much risk they want to take before they buy anything right now. Is that a healthy thing or unhealthy thing? I think that's very healthy. I don't think that's a bad thing at all. I think investors thinking about risk first and then thinking about the reward is very healthy, because we've seen the market where it goes when people are only thinking about the reward, right? And we've seen what that sets up for. So I don't think that's such a bad thing. I think that's very healthy. So in my opinion, this sounds like a buyer's dream market right now. A complete buyer's dream market for any long-term investor out there. Because, for all these things to happen simultaneously, this only happens like maybe once every 10, 15, 20 years, where you can have all these things happening at the same exact time. And we got one of those time periods right in front of us right now in 2022. And so for me, as a long-term investor, and for buyers in the market, I think this is a dream scenario, because, it could be another 10, 15 years before we get another one of these situations where all these things happen simultaneously. It happens very few and far between. And when it happens, you got to take advantage of that, right? Which is obviously why I'm a buyer out there in the market, right? Now, Wall Street is very convinced, and I see a lot of their opinions and perspectives on this. Wall Street is very convinced now that we're going back to those June lows, which would be S&P like 3,700, I think, maybe even in the 36s, but 37 something, okay? And I've even heard a lot of folks saying, we're going to 3,300, 3K over the next 6 months, which is certainly a possibility. You're going to need Apple. If you're going down there, you're going to need Apple to fall a lot. I mean, we're talking Apple $110, $100, something like that. So for Apple to fall like that, it's really going to need to report really poor iPhone numbers, and would have to be very, very pessimistic overall to get things to kind of go down there. So I mean, I'm welcoming of that if that does happen. But the thing is, people throw these things out, kind of like we just talked about with the Josh Brown thing yesterday about, we're gonna have face ripper rally. People throw these things out, and it's cool, it's opinions, but do we get down 3K? Who knows? Do we get down 3,300? I don't know. All I know is I got to take advantage of deals I see out there in the market, whether the S&P's at 3,600, 3,700, 3,800, 3,300, it doesn't matter. If I see deals out there, I got to take advantage. There's countless stocks that are extremely undervalued now. I can't sit on my hands and say, maybe you are going to hit 3,100 or 3,200. I'll wait to buy it then. Maybe we don't. Look at how much fear and pessimism is already out there in the market, right? No. Sometimes I like to kind of take a 35,000 foot, view of the markets, right? Because we get so caught up into 1 month, 6 month, year to date, 1 year charts and these sorts of things. And I just said, let's back it up. How's the S&P done over the past 15 years? And so over the past 15 years, the S&P 500 is up about 144% roughly. It's okay. I would call that like a May market. Hasn't done great, hasn't done horrible. That's kind of what that is. I mean, usually you should expect the S&P 500 to double about every 8 years, roughly, somewhere in there, maybe 9 years. 15 years, 144%. Okay, that's all right. But how's the stock market done in the 2000s, right? Well, we're up about 163% roughly on the S&P 500 over the past 22 years, which is once again, I mean, that's not that good, to be quite frank. Just not that impressive in terms of kind of what's transpired over the 2000s. So, yeah, I mean, I think sometimes just good to take a step back and look at these markets, how they performed over the past 10 years, 15 years, 20 years or so. And, a lot of people like to look at where it was at in February 2009 at the bottom and where it's at today. And it's like, no, dude, you don't look at it. You got to just look at these things. You can look at a 10-year, you can look at a 15-year, you can look at a 20-year, 25-year, whatever. And, it's quite intriguing kind of what you find, or, just how it's done in the 2000s, alone. Just how have we done in the 2000s? We've done okay, but we haven't done great, I would say, at least in regards to the S&P 500. So, yeah, hope you guys enjoyed today's video. As always, once again, check out attendees. That will be pinned comment to get access to everything I showed you earlier for free. Much love as always. I appreciate everybody for joining me as always, and have a great day.